Hey everyone, I'm Allis, and I'm doing a video on all that I've learned by 28. Today, as part of part 1 on everything I've learned about life, I'm going to be talking about money. Money is one of the most important topics to understand on your journey to being able to achieve anything you set your mind to. What is money though? Money was actually first used around 3500 BC by the Sumerians, and it replaced barter. Of course, barter is when you have one thing and the other person you meet has the thing you want, and you can simply exchange the two things, and both of you, through the trade, are better off. Money allowed for two individuals to exchange value, exchange goods, without both of them having to, by happenstance, have the exact thing that the other person wanted. And so all money is a store of value, which enables two parties to exchange even if they don't have something that the other happens to want. Because of course you can use money to buy something that you want later. So here are 3 key lessons I've learned about money so far. And these really were the 3 lessons about finance that my mom, Pauline, brought to me over the 18 years I grew up in her household with my dad. Number 1, spend less than you earn every month. Now that's not always possible, particularly when you're taking out a loan to go to school or during a medical emergency in your family. But as frequently and as often as you can, on a monthly basis, make sure what's coming in minus taxes is greater than your expenses. So if you're making $5,000 per month and paying 35% in taxes, you've got about $3,300, $3,400 you can spend on other things. And so if you're bringing in 5, but then after taxes really $3,300 and you're spending $4,000, you're actually going into debt every month. And there really are 2 segments of people out there. There are people who pay interest on loans every month, and there are people who earn interest on loans every month. And if you can either now or in the future get into that latter category where you can earn interest on the loans that you're giving to others, whether they be through savings accounts or CDs or lending club or some other instrument of investment, you can often grow through the power of compounding interest your assets over time. The second principle is to never go into debt for something that you don't need. Now, if it's an investment in education or investment in health or investment in your future or your family's future, that's one thing. But if it's that new boat that you don't really need and instead you could simply rent a boat 2 or 3 times a year when you really want to go boating, or if it's that big screen TV that's the 60-inch instead of the 50-inch and you just have to have it, if you can delay gratification for a few years and invest that couple $1,000s or a few $1,000s that you otherwise would have spent, that can turn into, over time, tens of thousands of dollars that will enable you to do so much more in your life. And the third lesson, the third key lesson, is save up early in life. Start young. And if you have kids, start your kids young on saving and investing, because the law of compound interest helps a lot over time. And I'll show this, I'll demonstrate this in the slides ahead. There are also 5 keys to building wealth. And a lot of these come from a book called Rich Dad, Poor Dad by Robert Kiyosaki that I first read when my mom put it in my hands when I was 16 in 2000. And after Rich Dad, Poor Dad, I read a second book by Robert Kiyosaki called Rich Dad's Guide to Investing. And in both books, Mr. Kiyosaki talks about his real dad, who was a professor, who didn't know too much about money. He talked about his mentor, who he calls his rich dad, who invested, who saved, who got out of debt, who built his own businesses, and over the course of a few decades built up millions of dollars, and that enabled him to do so much more than he could have otherwise, and really changed the world in ways that he couldn't have if he had not been able to invest in the causes and people that he really believed in. So here are the 5 keys to building wealth. And with many things in money, some of them are basic, some of them are not. Step 1, of course, is to pay off debt. Now, many people in the United States are in tens of thousands of dollars of debt, and that's okay. But the key is to not be getting into more debt every single month. Pay down that debt as quickly as you can and pay off your debt in the order of the highest interest rates first. And so if you have that credit card that's at 22% and you have that education loan that's at 4%, pay off that 22% loan first. Pay off that expensive loan and then pay off the least expensive loan. Paying off debt is like a guaranteed return on your investment. While in the stock market, you might get on average 10% or 7% or 20% or negative 30% in any particular year, paying off debt is getting a guaranteed return on your money equivalent to the interest rate that that debt carries. So step one, pay off your debt. Step two, build up your savings. Now paying off debt might take a year. You might actually be out of debt already. Or it might take many, many years. On average, you might take a year for every $5,000 or $10,000 in debt that you have. So it could actually take a decade or 2 decades to pay off $30,000, $40,000, $50,000, $60,000 of debt. That's okay. Just work at it every year. And the key is to have at least 10 or 20 years prior to retiring where you can actually build up savings, build up positive net assets, and be able to invest those so that you can retire and eventually have your money work for you and make more money for you, rather than having to use your labor to do additional work to get more money. As you pay off your debt, you're going to start having a surplus. And when you have a surplus of net assets, those of course are called savings. And once you have savings, you can do things with your savings. You can invest them in a money market savings account at your bank that might pull back 0.5% or 1% in return a year. Although once you look at the effect of inflation, which recently has been averaging about 2.8% per year, by keeping your money in a savings account, you're actually losing money every year. Actually, anything that produces less than, say, 2.8 or 3% per year in return, you're actually losing money. And your principal, the amount of money you have, is getting depleted over time. And so it's really important that you not only invest in safe investments like treasury bonds and certificates of deposits and savings accounts, but invest in other types of assets that we'll talk about shortly that can produce higher rates of return with not too much more risk. And certainly over the long term, produce much higher return. In fact, it's one of the riskiest things you can do to keep your assets, to keep your savings in very low negative return in investment instruments. So the next step, once you build up savings, is to invest in cash-producing assets. Now, getting out of the middle class, in other words, moving to a point where you don't have to work and you can make money from your investments, requires having cash-producing assets. And a cash-producing asset is simply something that every period of time, whether it be a month or a year, ends up being worth more than it was worth previously. So it could be ownership in a business, it could be a certificate of deposit, it could be really anything, it could be a treasury bond. Here is a list of some of the most common cash-producing assets out there. And you can see that they range in both return and risk type, ranging from savings account at the low end to potentially hedge funds or venture funds at the most volatile, potentially highest reward end. Step 4 is to use the cash flow that your cash-producing assets, your investments, are producing to make more investments. And this is really one of the keys, because if you can invest the returns from your investment, they will accumulate, they will compound much more quickly. In fact, much more quickly than if you use the cash flow and don't reinvest the cash flow from your investments. And so once you have a few stocks and bonds and different things that generate cash for you, take the annual returns that are hopefully above the rate of inflation and just keep them in. Keep replowing them in to invest, and your assets will grow even faster. Step 5 is, as you work, make sure that you're working for companies not only whose mission you believe in, but who will give you a share of the upside, give you ownership or options to purchase ownership in the firm that you're working for. In fact, if your current firm won't give you the opportunity to have stock options, I'd have a conversation with your executive team, because they are losing out on an immense power of when you can align what you love and what your company loves and be able to align the economic incentives for your company and your own economic incentives, oftentimes yourself and your workforce will experience much higher productivity. Finally, the last step is simply to continue this cycle, right? So step one, pay off your debt, build up your savings, have net positive savings or net assets, invest these positive savings in cash-producing assets that create cash flow. We'll go through more of those in a minute. And then use this cash flow to invest in more cash-producing assets while earning equity and ownership in the companies you work for or the companies you start as an entrepreneur. Then continue this cycle over and over. This is the simple formula for wealth. It may be simple and clearly on the screen, but very few people actually follow it. And if you follow this formula, not for 1 year, not for 5 years, but for 20, 25, 35 years, you'll most likely be much better off. And so Robert Kiyosaki, the author we spoke about earlier of Rich Dad Poor Dad, has a really interesting quote. He says, individuals in the middle class accumulate more debt as they become more successful. A pay raise qualifies them to borrow more from the bank so they can buy personal items like bigger cars, vacation homes, boats, and motorhomes. Their wage income comes in and is spent on current expenses, and only then on paying off their personal debt. So as their income increases, so does their personal debt. This is what we call the rat race. His second quote later in that chapter is, the rich have their assets work for them. They've gained control over their expenses by saving and investing money each month and focus on acquiring or building assets. Their businesses pay more of their expenses, and they have few, if any, personal liabilities. And so some of the key lessons, some of the takeaways about money, one of the most important ones is if you save up and invest, you can expect to have more in the future. Here's a table of what you might have in the future if you start investing today. So if you save $1,000 for 20 years and invest that with a 7% after inflation return, you'll have $520,000. Now, if you save $1,000 for 30 years and invest it, you'll have over $1 million. Now, you can use this table to solve simple things like if you want to make $1 million in 20 years and have that in your bank account in today's money, today's dollar value, you need to save $2,000 for 20 years and invest it in investments that produce an after inflation return of about 7%. So I'll talk in just a moment about different types of investments and which you can invest in and which produce the highest returns for the lowest volatility. But I want to emphasize this, that yes, it's hard. It can be often very hard, especially with unexpected expenses like healthcare and the cost of living going up nearly every month, if not every year. But if you can find a way, particularly earlier in life, but really any time in life, to save $1,000 a month and keep that habit for 30 years and invest wisely, many times you'll end up with over $1 million. And the key to true wealth is to eventually accumulate enough money so that you can just make money from your money. And if you think about it, if you take a very safe investment, or if you take a generally safe investment, let's say a tax-free municipal bond that might pull in 4.5% to 5% a year. If you can save up and through your investments over the course of 30 or 40 years during your career, $3 million, which is achievable by saving $1,000 and investing it for 45 years, or $2,000 for 35 years, $3,000 a month for 30 years. 5% on $3 million is $150,000 per year. And at that point, maybe even less than that, depending on your current living expenses and your family's needs, you'll be able to live entirely off of the returns and the cash flow from your investments. Is it easy to get there? No. Is it possible to get there for nearly anyone over the course of 35, 40, 45 years? Absolutely. So let's talk more about investing wisely. there are really two types of investments: debt and equity. Debt investments are loans. You earn a fixed interest rate every period, say every year. You might be able to give a loan to a neighbor and get a 10% annual return. You might be able to invest in something like Lending Club and distribute your loans across hundreds of people and get a diversified return. But whether it be a treasury bond, a savings account, a loan to a friend, or a loan through Lending Club or Prosper, debt investments are loans with a fixed principal, a fixed interest rate return. Equity is different than debt because equity involves investments of money in exchange for partial ownership in a venture, in a company. So equity investing is simply purchasing equity, which is another name for stock or ownership, in a for-profit business. With equity, you don't get a payment except when the company distributes profits, which are called dividends. You primarily get most of your return usually when the value of the company goes up. In other words, when the market values the company more because the level of that company's profits or expected future profits has risen. And so with equity, you make money when the value of the company goes up. And there are many things in the market that make a value of a company go up, but generally it's when their present value of their future expected cash flows is higher. And present value just means the expectation of the future discounted to today. And so bringing together the different types, these two different types of investments, you can see there are dozens of different types of debt and dozens of different types of equity. This is a list of just a few of them, ranging from savings account, treasury bonds, muni bonds, corporate bonds, peer-to-peer lending, which are all forms of debt, to different types of equity, which could range from mutual funds, index funds, exchange-traded funds, emerging market investments, private companies, venture funds, hedge funds, options, which are rights to buy in the future, or rights to sell in the future even, with put options. And so there are many different types of equity, and one could go through an entire course on learning how to be a good investor, maybe an entire semester of courses on becoming a great investor, maybe even years of content, but understanding these basics are really important. So as we talk more about debt and equity, particularly equity where the return is often variable, in other words, it has volatility, it's important to know that there is a correlation, which just means something that generally happens when another thing happens, between return, which is the amount of money you make back during a period of time. So if I have $1,000 on January 1st and then I have $1,100 on December 31st, then I've earned a 10% return on my money that year. And volatility. Volatility is the fluctuation in price. And a lot of people choose not to invest in the stock market because they think it's a gambling game of speculation. And the reality is that all a stock market is a place that enables people to buy and sell ownership interests in companies. And one of the greatest wealth-producing vehicles of all time is ownership interests in businesses. The average return, the Dow Jones Industrial Index, since 1932 until the end of 2011, was 10.6%. That's pretty darn good. And even when you take out inflation, that's still above the 7% after inflation's returns that you'll need to achieve the goals stated in that prior table. And so that simple example before, how you can have $1 million in 30 years, well, save up $1,000 a month, every month, and invest it at a 7% or higher after inflation return. To have $1 million in 20 years, you need to double that because of the power of compounding and save $2,000 a month for 20 years. And so now let's look at the average annual returns by type of investment, including both common debt instruments, common debt investments, and common equity investments. Now, these are averages, and the data here comes from a handful of sources. Now, you might look at something like the Dow Jones Industrial Average over the course of 50 or 60 years and see that the range generally ranges between 9 and 11%. You might look at something like savings accounts, which are very, very low, often less than 0.5%. Even the best banks will give you 1% on your money back each year. And after inflation, Often many of these debt instruments have a negative return. So savings accounts, certificates of deposits and treasury bonds. You might think you're making money on your money, but you're actually losing money on your money. And that's not worth the risk. It's the riskiest thing you can do, is to have a guaranteed negative return every year. Now, less risky is investing in things that you have a positive after inflation return. There are things like muni bonds, corporate bonds, and lending club notes, which I'll explain more about in a minute, that enable you to take some risk, but on average after inflation have a positive return, which over the long term may give you a better return overall. Now, equities, which are the bottom S&P 500 index and the Dow Jones Index Fund, often over the long term have some of the best rates of annual return, but are the most volatile, which means they fluctuate the most year to year. Many of us remember 2008, in which the stock market dropped quite a bit. Fewer of us remember 1929, the other time when the stock market dropped a lot. So whether it was 1932 or 2001 or 1987 or 2008, there are many times when the stock market has dropped more than 25% in a year. But over the average, even including all of those metrics, we still see double-digit returns before taking out inflation. One of the areas I've seen to be most exciting recently is peer-to-peer lending. And Lending Club is one of the leaders in the market for peer-to-peer lending. Peer-to-peer lending is when you as an investor, someone with savings, can invest in a number of loans that are given to other people that are seeking loans in order to pay off and consolidate debt, in order to go to school, in order to go travel or have a wedding. And oftentimes the interest rate on these loans will range from 6% at the low end to 24% at the high end. And even after default, organizations like Lending Club are able to provide, at least for the time being, a very attractive return. So one interesting investment option, as I mentioned, is Lending Club. I started investing with Lending Club earlier on this summer and have seen interestingly positive results so far. One of the ways that they enable you to have lower risk, yet get a pretty good return, even with a debt or loan type investment, is by diversifying the money you're lending, $25 at a time, into hundreds of different loans. And so if you put in, say, $2,500 investment in Lending Club, you can select 100 loans. And so if one loan defaults, you'll only be losing 1% of your principal, the amount of money you put in. Now, Lending Club can be risky, but if you look at the data, it's, at least for the time being, providing one of the lowest risk on a risk-adjusted return basis ways to generate double-digit returns on your money. Lending Club enables you to select loans to be provided from you to the recipient based on many risk factors, based on demographics, based on states, based on credit score, based on history, based on how much credit they have outstanding already. It enables you to very clearly narrow down options as you choose. They also give letter grades to each of their loans, each of the recipients of loans, ranging from A to F. And what I've found personally is that the A, B, and C loans are, of course, the safest, but they also have the lowest return. And what you want to look at is the combination of safety and return averaged out across multiple loans. And at least the data that Lending Club publishes is showing that for investors that invest across hundreds of loans, again, $25 per loan, they're able to get higher after default returns from the D, E, and F lending notes that they provide. And so, of course, past performance is not a perfect predictor of future performance by any means. However, I would absolutely encourage you to take a look at peer-to-peer lending organizations like Lending Club and Prosper as part of your investment mix. One of the key important parts of investing is understanding some really basic ratios. And I won't spend a lot of time on ratios because that's probably better saved for more advanced courses on investing. But I have found the most important ratio in investing is price to earnings ratio. And what that means is the total value of the company currently divided by the total annual earnings of the company. And so if a company is worth $1 billion and has annual earnings of $100 million, then the price to earnings ratio, or PE ratio, is 10. 1 billion divided by 100 million. Now, PE ratios can be calculated quarterly. It could be an average over the course of a prior few years. But pretty much every major stock index has an average PE and that is reported. So if you go to Google Finance or Yahoo Finance or any brokerage, you can get the price to earnings ratio for any stock. Now, higher growth stocks often have higher price to earnings ratios because, again, the value of a company is whatever the market thinks the equilibrium between buy and sell is, but it's also the present value of future cash flows, future profits, future net income of the company. And so if the future profits are expected to go up because of a higher growth rate, you'll have a higher current price to earnings ratio. Conversely, if growth of revenue and growth of profit is slower, you'll often have a lower price to earnings ratio. And so one way to think about it is, if profits did not increase at all, how many years would it take you, assuming the company provided all of their profits back to their shareholders in the form of dividends, to make the money back on your investment? And so if you're putting in $100 and you're getting $10 in profits for your share of the company per year, it would take you 10 years to get that money back. Now, the average price to earnings ratio, going way back to the early 20th century, is on the stock market about 16 or 17. And we're actually in a time where PE ratios are inflated higher than their historical averages. There's a professor at Yale by the name of Arthur Schiller who calculates the price to earnings ratios historically by stock market index. However, when you're looking at individual companies to invest in, a PE ratio can be very valuable, even if it's 20 or 10 or 30. One of the reasons Facebook stock has declined so rapidly over the summer of 2012 is because it went out at a price to earnings ratio above 200. What that means is that it would take 200 years for Facebook shareholders to receive back the money from their investment in Facebook if Facebook's profit were in equilibrium, in other words, didn't grow. Now, of course, Facebook's profit is potentially going to grow in the future, or at least that's what they believe, and so people are willing to take that risk, and potentially in a market with low demand or high demand and low supply, you're going to see higher prices. What's happened though in the last 3 months is Facebook stock has declined in price from over $40 a share to less than $20 a share, a 50% decline. And even now, after declining by 50%, Facebook's price to earnings ratio as of August 2012 is still over 100. And when you look at a company like Google, whose price to earnings ratio is about 20 and many times the size of Facebook, you often see why some people are shifting their money from Facebook, which is a high risk, probably high volatile, very high PE investment, into lower risk, slightly lower volatile, lower PE investments, like Google or Apple. Even Apple, which is the most valuable company in the world by market capitalization today, has a PE ratio under 20, less than 1/5 that of Facebook at the moment. Understanding these basic things about investments and ratios will be very critical to your ability to choose wise businesses and operational teams to invest in as you grow in your investing career. Picking stocks is not about throwing darts at a newspaper. It's not about getting lucky. It's about understanding companies, management teams, products, and societal trends, and investing in companies that have a margin of safety in which the price to earnings ratio and the rate of growth and the team will enable you to, more often than the average investor, pick winners. Now, angel investing is purchasing ownership in an early stage private company. Angel investing has become all the rage here in San Francisco and in Silicon Valley, and today for a company with not only no profits but no revenue, in other words, they have an infinite price to earnings ratio and an infinite revenue multiple, you're seeing valuations starting at $5 million for a company that might only be a couple months old. In fact, as many of you have heard, Instagram was acquired in 2012 by Facebook for about $1 billion, which was an infinite revenue multiple and an infinite price to earnings ratio, as they had 13 employees and no revenue and no profits. Now that's a rare example. That's an edge case. Oftentimes it could take decades to build a company to be worth $1 billion. But for the people that invested early in Instagram and other companies that have done very well here in the innovation capital of the world, Silicon Valley, they have enabled an ecosystem that creates more and more demand for early stage, high technology, and deep scientific companies that are working hard to make a positive impact in the world through science and technology. So one of the more complex theories that maybe your financial advisor might be aware of as it relates to investing is something called portfolio theory. Now, this is something, if you went to business school, you definitely know about. But it's something that most people, they may have heard of, but they might not know what it's called. And portfolio theory is a complex topic, particularly mathematically, but it's actually really easy to understand the concept. And the concept is simply that for an average investor who doesn't know really the difference between stocks and bonds and price-to-earnings ratios and current ratios, returns are maximized by having a large basket of investments and including some non-correlating or low-correlating asset classes. In other words, if, say, gold has a low correlation, in other words, it moves not in the same direction as stocks or equity markets, then you include some gold, or you might include some debt, you might include some bonds in with your balance of investments. And portfolio optimization theory over the last 30 years has created many Nobel Prize winners. But the reality is that portfolio theory is only true if you don't know what you're doing in investing. And if you take time to do your diligence and do your research, understand price-to-earnings ratios, understand societal and geopolitical trends, oftentimes you can select companies that in the future will be worth more than they are worth today based on an increase in their present value of future cash flows. And so portfolio theory can easily be beaten if you take some time to invest in knowledge and diligence. And because in practice, when you look at the highest returning individuals, people like Warren Buffett, who have achieved over a 20% compound annual growth rate, going back to 1956 over the course of nearly 55 years. In practice, the highest returns are seen when you invest in just a few eggs in your basket and you watch that basket very closely. You understand which eggs you're buying and why. And so Warren Buffett's investing method, it's pretty complex. But at the basic level, besides having a rather good knowledge of how to read a financial statement, the core thing he learned back in the 1950s at Columbia University from the father of security analysis, Benjamin Graham, was to always have a margin of safety with your investing. And if you understand a firm well and you can calculate with the information you have the expected future profits of the company, and you can look at what the market thinks the company is worth versus what you think the company is worth with your calculations, and have a sufficient margin of safety, and pick those companies. It's not just good companies with good management teams with good products, it's good companies with good management teams with good products who the market has mispriced for lack of understanding that asset, that security, that investment, that company well. And so if you have fewer things to understand well, you can gain an information advantage or information arbitrage against the other people who are investing in that same company. So that's not insider information. That's just doing your research and only having a few assets to understand at once. So in summary of this section, you can become wealthy over time by paying off your debt, by saving, by using the results from your saving to invest, and to use the proceeds from that investing to invest more, and not going into debt for things that you really don't need and can delay gratification on. And so there are two different types of people in this world, and people can shift from one segment to the other. But there are people who pay interest on loans and work for companies, and there are people who receive interest on loans and own parts of companies. And a really important question is, which segment are you in? And if you're in number one right now, think about how in the next 5 or 10 years you can go from paying interest on your debt and working for companies you don't have ownership stakes in to receiving interest on loans that you make and owning parts of other companies that produce cash flow for you and your family. Thanks for watching this video on money and investing.